The U.S. economy continues to be the locomotive most closely watched by global financial markets. Last Friday's employment data caused a significant stir in the markets. Weaker-than-expected job creation intensified speculation about the Federal Reserve's Fed monetary policy. Many analysts believe these soft figures signal that the Fed may slow its aggressive interest rate hike cycle or even move towards rate cuts. Along with this expectation, S&P 500 and Nasdaq 100 futures rose, indicating investors' hope for a looser monetary policy. However, inflation remains the Fed's top agenda item. Consumer Price Index (CPI) and Producer Price Index (PPI) are closely monitored, while fluctuations in energy and food prices continue to exert inflationary pressure. President Donald Trump's signing of a reciprocity-based tariff decree opened a new era in global trade. This decree, by determining customs duty rates to be applied to specific countries, signals a move towards a more protectionist approach in U.S. import policies. Trade tensions, especially with China, continue to exert pressure on the semiconductor and technology sectors. Tech giants, Apple, NVIDIA, Microsoft, Amazon, Meta, and Tesla, and their upcoming earnings reports remain a focus for global investors. Developments in sectors like artificial intelligence and electric vehicles significantly impact market valuations. Consumer spending and the housing market are also among the other indicators closely watched by the Fed and economists. The Canadian economy remains overshadowed by its trade relations with the U.S. The US's increase in customs duties on Canada from 25% to 35% could lead to a significant decline in bilateral trade volume and exert considerable pressure on Canada's export-oriented economy. This situation is causing the Canadian dollar to depreciate against the US dollar, making it harder for Canadian companies to access the US market. The Bank of Canada, BOC, is also striving to combat inflation and maintain a balance in economic growth within the country. Potential changes in U.S. interest rate policies directly influence Canada's monetary policy decisions. Canada's economy heavily relies on natural resources, especially oil and natural gas, and raw material exports. Fluctuations in global energy prices have a direct impact on Canada's trade balance and gross domestic product, GDP. The energy sector, particularly in Alberta, is largely affected by these fluctuations. Additionally, an overheated housing market and high household indebtedness are also significant risk factors for the Canadian economy. The government is working on new investment incentives and trade agreements to support and diversify economic growth, but trade tensions with the U.S. overshadow these efforts. The Mexican economy is significantly influenced by its strong trade ties with the U.S. under USMCA, United States-Mexico-Canada Agreement, which replaced the North American Free Trade Agreement, NAFTA. The new U.S. tariff policies could pose a potential threat to Mexico's exports, especially in the automotive and manufacturing sectors. However, remittances, money transfers from abroad, particularly those sent by Mexican workers in the U.S., continue to play a vital role in the country's economic stability and provide a significant source of foreign exchange. The Bank of Mexico, Banxico, is also maintaining a firm stance in combating inflation. High interest rates help keep inflation under control but also put pressure on economic growth. The tourism sector has shown a strong recovery after the pandemic and has become one of the country's important sources of foreign exchange earnings. The fight against drug cartels and regional security issues are among the significant risk factors affecting the country's investment environment. The government is focusing on poverty alleviation and expanding social programs, while also trying to attract foreign investment to develop the country's infrastructure. Thank you for watching the video. Please like the video and subscribe to our channel.